Recording. Hello, everyone. We are going live on Facebook, and we are excited that you are joining us. We're going to give everyone just a few minutes to pop on here. And tonight, we are going to be speaking with Frank Vasquez, host of Risk Parity Radio, and a huge friend of the financial independence community. I cannot think of anyone who has more selflessly just answered questions. He probably spent too much time in the Choosify group, but it's to all of your great benefit. His answers are researched, they're in-depth, they're incredibly knowledgeable. It's someone Brad and I, both of us, go to on a frequent basis. And I'm just excited to share this conversation that we're about to have with you. So I guess, first of all, to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, this should be a lot of fun. First off, Facebook Live has been good to us. We had our year-end wins episode at the end of 2020, which was a huge success. So yeah, we figured this was a good platform to continue our lives. And what a way to kick it off, but with Frank here. So yeah, this should be a lot of fun. Basically, I guess we build this as really like a 201 or maybe even 301 level conversation about the nuances of investing. And I think that should be a real blast because, as you said, Frank is, I almost can't believe how much time he spends in the Choosify group.
Let's not talk him down. We appreciate the time that he spends there.
It's astonishing. It's astonishing. So yeah, Frank is a true expert. So yeah, it's just good to have him here. And it's very nice. We're already getting comments here. Hey, from Virginia, Charlottesville, Colorado, Montana, Tucson, Texas, California, North Carolina. This is great. Yeah. So let us know where you're coming from today. And then most importantly, send in your questions. Frank, like we said, this is, as much obviously, Jonathan, as you and I talk about our own strategies of investing, it's pretty tame, in the grand scheme of things. But Frank, I think, can really, really dive deep into this. So, all right.
Well, the nice thing about this, Brad, we're kind of having an extended intro here a little bit for the Facebook group because many of you have probably seen Frank comment in the group and you've probably maybe even had questions answered. So we're going to take this episode and repurpose it for our podcast. It'll be coming up in a few days or maybe in a week or so. But it'd really be cool for you guys to all be able to participate and share your questions. So we will get more into it. Let me just set up one more content. Actually, I tell you what, let me do my intro again for the podcast, right? Recording this for the podcast. And then we'll come back on the other side of that. And then we will set up kind of a framework for the episode. We'll welcome Frank on and then we'll go from there. So
yeah, everybody gets to see how the sausage is made here. This is cool. So
I know.
Let's do it.
It's going to overwhelm people with its
yes, we are very impressive. If you hear me stumble over my words and say them again, it's for the podcast.
All right, guys, today we're going to be taking a look at complicated portfolios, risk parity. Are you as diversified as you think you are? And what purpose does your diversification serve? And we're going to be creating this episode with the help of longtime community member Frank Vasquez, who is also the host of Risk Parity Radio, probably the fastest growing niche financial podcast in the entire world. Highly recommend that you check it out. Take me up on that. We did an episode with Frank, actually, highly recommend that you check it out. See how, like, when you make a mistake, you can just get a mulligan. Sometimes that happens.
Never exists on the podcast.
That's right. Welcome to the ultimate crowdsource personal finance show. This is Choosify. All right, guys, really excited to dive into this episode. Again, as we mentioned, we're going to have Frank Vasquez from Risk Parity Radio on the show with us today. If you have not yet checked out episode 194, you can find it at choosify.com/194. And in that episode, we talked about the role of bonds in a portfolio, kind of limiting ourselves to that very kind of focused topic for the purposes of really exploring the parameters, what makes bonds, what similar characteristics do all bonds have, and what makes them different. And Frank really helped us explore things through the lens of, I believe, stability, inverse correlation, and
you're really going there.
One more was. It's three. There's three reasons, and we're going to get Frank to let us know what that third one is. With that, Frank Vasquez, welcome to the show, buddy. How you doing?
Good. And
all right, you want to help me out? What's the last one?
Yeah, those three are income, stability, and diversification. And diversification is what you're thinking about with inverse correlation, because those are the most diversified bonds from stocks.
All right. Well,
Yeah. And Frank, that reminds me of a quote you have here on the homepage of riskparityradio.com from Ray Dalio, author of Principles. And he said, the holy grail of investing is, quote, making a handful of good, uncorrelated bets. It is the surest way of having a lot of upside without being exposed to unacceptable downside. And yeah, that just jumped off the page to me, because I think that's what we're all looking for here. When you try to diversify, I think a lot of us are looking for, whether we know it or not, frankly, these uncorrelated bets. But are we really getting there? I think that's a question a lot of us have to ask ourselves. So yeah, I mean, I think that's something I would personally love to dive into for a significant portion of the conversation.
I mean, that's what I call the Holy Grail principle. It's named after that. You can find Ray Dalio on YouTube talking about his Holy Grail principle, and but is to really focus in on what does diversification mean. And I think it's a word that gets kind of thrown around, and when people first start investing, they think it means, and that's really not what it means in terms of constructing a portfolio. What it means is uncorrelated. And
Frank, you're locking up a little bit.
Yeah,
yes.
Frank, your video cut out, your audio and your video cut out for a second there, and I feel like the words I missed were almost selected by design to be the most important.
The single most important. Yeah.
Let me just repeat that.
Let's start over. And we might, if we have to kill your video, then so be it. But we'll give it a whirl.
We have a podcast; it'll be okay. But no, let's try again.
I apologize. Okay, so what I was saying, that diversification just doesn't mean different. It means uncorrelated. And the way you measure that is with a number. And you can look up now on a site like Portfolio Visualizer, take one of your funds and another fund and put them in there, and it will give you a number from -1 to 1. A number that is close to 1 means the two assets are correlated, or the highly correlated. So they do the same things, essentially. Now, if you have two assets and their number is around 0 or getting close to 0, that means they are uncorrelated in the sense that they just move randomly differently. If you get a negative number when you do that, that means they are negatively correlated, and they typically go in the opposite directions from each other most of the time.
Help people think this through, why we would want that. For instance, I'll just give you the example here that it's kind of a straw man, but I think it's important for people just to think through follow this logic to its natural conclusion. I'm in stocks. My stocks are doing great. I have something that's uncorrelated and it's doing horrible. Why would I want any losers? That's the one. It's so someone that is potentially accumulating. They're trying to build wealth as quickly as possible. And they're like, why would I want something that's not correlated with something that I have that's doing well? Help me play that out and talk about uncorrelation, how it might affect an individual investor's path to financial independence.
Well, I think you said some magic words there, which you said is accumulating, because you probably don't need these negatively correlated assets if you are in your accumulation phase, because you are trying to build a large portfolio. You're going to invest mostly in the best things that do that, which happen to be stock funds, at least as we commonly know. And you are willing to take on lots and lots of volatility because you don't plan on using that money soon. Where this matters is when you get to FI, or you're getting close to it, or you've accumulated a big portfolio and you're just getting nervous about it. And so you want a portfolio that essentially has the highest safe withdrawal rate that you can have for that portfolio, particularly if you're drawing down on it. And that number, I mean, we throw around the 4% rule, but that's based on one simple portfolio of stocks and treasury bonds from the 1990s. Every portfolio has a different safe withdrawal rate. And they're not all wildly different. It's not like you're going to have one that's 10% and one that's 0 but they're all clustered, say, between 3 and 5.5%.
Frank, how do you can I just interrupt? How do you calculate that with any degree of certainty? Like how would one know that?
There are two good sites for where you can run these calculations. One is called Portfolio Charts, and you can put in a wide variety of portfolios, and it has 50 years of data. It goes back to 1970, and that gives you a pretty good idea of at least comparing various portfolios as to what that might be like. And what's nice about going back to that period is it covers an inflationary period, a couple of growth periods, a deflationary period. So we've seen, all of those things happen. And I apologize, the phone is ringing in the background. I can't do anything about it.
We found someone who still has a landline.
Yeah,
folks.
old school landline.
Love
finally got rid of mine about 2 months ago.
So the other place to do this easily is called Portfolio Visualizer. And that site has a much broader database in terms of you can put in lots of individual funds, whereas Portfolio Charts, you're just putting in like asset classes, like a total stock market or a small cap value fund or a international fund. In Portfolio Visualizer, it lets you put in specific funds, but you're only going to get an analysis for however long that fund has existed. You can also put in asset classes and get some analyses that go 1980s, which are useful. We are, I think, in an era where we are able to do so much more as individual investors than we were even 5 years ago. These sites did not exist, and now we have a lot more data and tools that are available, so we can think more about what different assets in a portfolio are going to be like. Because in the past, it was a lot of guessing, and we had to just sort of rely on a few chestnuts, a few articles, a few the information that somebody with lots and lots of data, but some hedge fund or something had written a big paper on at some point, going back to those things in the 1990s. Believe it or not, what the biggest tool that Ray Dalio used to come up with all these things back in that time period was an Excel spreadsheet.
Go get along great. Just sharing their Excel notes with each other.
If you could imagine, and now the tools we have are just much more superior, and we can do much more with them.
Frank, if I were to solicit from an audience someone's, portfolio, their allocation of stocks to bonds, et cetera, could we at some point in the future, like literally go through the process of mapping out that portfolio? We'll record it, mapping out that portfolio on,
Sure.
Portfolio Visualizer or Portfolio Charts.
Sure.
And then the follow-up to that is I felt like you were saying that you could then draw conclusions from past data. Clearly, this is all retrospective from past data, but based over 50 years of good data, and then I guess more data that is less good, but we could then draw a conclusion from that of what a good, safe, a relatively reliable safe withdrawal rate would be based on that exact portfolio. So there is like something to be said for like, as we start to aggregate our portfolio, as we start to think about these conditions and we build these assumptions, and something like what you just described, would it actually be able to help us come up with a safe withdrawal rate?
Yeah, it comes up with an estimate. I mean, these are always going to be estimates. But then they also have more calculators there. For instance, at Portfolio Charts, you can find a retirement withdrawal calculator. And that allows you to put your portfolio in and do an analysis of how many times would that have failed in the past 50 years if you would have used it, and you would have, say, taken a 4% withdrawal rate or a 5% withdrawal rate or withdrawal rate. Because one of the wonderful things about that particular calculator is it allows you to have different rules for withdrawal. One of the things that is really lacking, I think, in the financial independence community is understanding what that 4% rule was, and then how is that probably not what you're going to use, and how can you use a more like a variable withdrawal rate is what most people are going to be using, that they're not going to be taking amount every year and then increasing it every year for the rest of their life. They're probably going to be taking out some more in good years and some less in bad years. And if you have that kind of flexibility, that also plays into the survival of the portfolio, if you will.
Gotcha. Frank, I want to ask a two-part question here. I know you said a couple of minutes ago that this is really, your strategies that we're talking about tonight are really for people as they're approaching FI, retirement, whatever you want to call it. I know you have a couple of sons, 3 sons, I believe, under 30 or thereabouts. In the accumulation stage, I'd love to just hear like a super quick overview of what your kind of optimal advice would be for your own sons. And then, the second more nuanced part would be, as we get closer, I think a lot of people, we get closer to 5, we get closer to retirement, whatever it may be. A lot of people don't know how to manually change. So you go from, hey, I've got 30 years worth of accumulation and built-in gains and all this stuff. Like, how do I then get to one of these portfolios? So I know that's, never good to ask a question with 2 parts, but I'm confident that you can handle it.
You have a penchant for it.
Especially when they're 2 unrelated questions.
You're welcome, Frank. And go.
So let's talk about what I do with for how I advise my children. We have 3 sons. One is 25. He's been out in the workforce for a couple of years. One is just graduated from college, and he got a job, and so he's going to be on his way. And then we have another one in along. What I have advised him to do is, he didn't really want to pay them good in particular, that max out your retirement accounts and put it all in basic index funds. And so he's got the Fidelity, they have Fidelity at where he works, and he's got the total market or the S&P 500. I can't remember which one it is, and that's where most of his money is being saved. He's more recently became more interested in sort of the nuances or different, thinking about other things. But let me tell you more about, there are other things that he's doing that we use the stuff that I build out for. First of all, he's got an emergency fund, and that's like the first bucket that gets filled up, and so whenever something comes off the emergency fund, he's got more in there than he needs to. Then he moves it into a taxable brokerage account, and what he uses that for, or has used it for, was to put a down payment on a house and do house hacking, because he read Scott Trench's book and went wild about it and decided that's what he wanted to do. And so he's got 3 former roommates, now tenants. Wow. But the way he saved in that account is by using a risk parity style portfolio, because this kind of portfolio is also good for intermediate term savings. If you have a goal that's somewhere like between 5 and 10 years, you could say this with virtually any kind of retirement style portfolio would be good for that. But the kinds of portfolios I'm talking about only having a max 20% drawdown and max 3-year time period for the drawdown. So they fit in for that, and I'm sorry about the dog now.
A zebra run through, and
they fit into that intermediate time frame that you could use one of these kinds of portfolios for. And just one more comment on thinking about your accumulation phase for the younger folks. I think the way, and what gets people nervous about putting that first money in, and they say, just put it all in the stock market and go, and they're like, oh my God. But I think you want to pull back and think of it more holistically. When you start out, what you are actually sitting upon is a Gwen's commenting. What you're actually sitting on is essentially a pile of future cash. You are planning on investing, I don't know, $300,000 over the next 20 years or some big number like that. If you think about that, that is all just in cash. And you only are allowed to invest a little bit of it each year. So it is incumbent on you to get that into the risky, most growth-oriented things that you can find that are reliable, which happen to be stock index funds. And so that is why it makes the most sense to really just focus on getting it in there. I think the other advice I commonly give to the beginning investors is you only need one fund until you have about $100,000 in there. Or your annual salary is kind of a guidepost. And the reason that is that it is really all about the earning and saving at the beginning of this journey. That the investing part, you put $5,000 in there, you make 20% on it. That's $1,000. When you have $100,000 in there, that's $20,000, and all of a sudden your investing means more. But that also gives you the time to go and read a few books and think about, what you ultimately want to do with your investments. In the meantime, just having that one fund is fine. You don't need to optimize, your first 401k or anything like that, because we just want to get people going on that.
I love that. I think that is that's a sorely missing piece in terms of the simplicity. Like people sometimes want to go straight to complexity, and then they freak out when they see the complexity, and then they just don't do anything. And I do think in my own personal finance journey, I don't know if I had that framework in mind quite as much, but I do remember getting to a net worth over 6 figures, getting that first 100K. It kind of opened up a door to another phase where if you are ready to embrace a little bit more complexity, if you are ready to, you have a good foundation, you want to do more. But I think for everybody, just getting that first 100K is like, keep it simple. And it's going to be mostly driven on your savings rate. You're going to have to front load that work. But once you get to 100K, like if you do make 8% returns, we're looking at $8,000 a year that your money is now earning for you going forward. We've now built a very significant, income earning entity that works 24/7 on our behalf. And maybe sometimes it makes more, sometimes it makes less, but you've truly moved to this point where your money is making substantial amounts of money for you. And for me, I do feel like that realization kicked in right around 100K. And you realize this is real.
There's a nice article written by Michael Kitces that I can give you guys and you can link to, that is about essentially the 4 phases of investing, and the first 2 are earning and saving, and earning and saving are the most important things to begin with, and getting that automated savings going, and then stage 3 is investing, and it doesn't become important in terms of managing that until there's more in there, and then you get to the 4th stage is managing your investments so they don't blow up or go away. The other thing that you can think about is you're building a kind of an edifice of investments. You're always going to want to have a big portion of just a basic index fund in there, and so there's no necessary need to putting more things in there until you get a good thing accumulated. I'm not discouraging anybody from doing those sorts of things, but I'm more talking to people who are just trying to get going and wondering if they're doing the right thing by one thing, and should they be doing more? And the answer is no, you don't need to. You're getting 80% of the value of investing just by doing that one simple thing or those 2 simple things.
Frank, just a quick follow-up to something you said about your son. So the interplay between his, starting out and getting that base that you're talking about of the low-cost index funds, et cetera, with, you said he started implementing one of these risk parity portfolios for a concrete goal, I guess, of buying this house. What is that interplay? Like, how do you advise somebody who, I mean, there's obviously finite money to save, right? And you're 22, 23, 24, whatever it may be. Like, how do you prioritize, I guess, the goal and using the risk parity portfolio with the long-term accumulation?
I told him, the long-term accumulation sort of comes first. And he's a frugal guy. And so he's completely maxed out the 401k, the IRA. He's got something called a 401a that his employer puts more money into. Wow. And so, he's got a saving between $25,000 and $30,000 just in that. And that's more than enough for
so his pieces are covered.
He's got a very high savings rate, and now that he's house hacking, he's not paying any rent, and so all that's going into his risk parity portfolio, and he's just he's doing what Scott Trench described in that book. It's just kind of
it's a great book. It's a great book, man. So I committed the cardinal sin of interviewing, which was asking two questions at once. So maybe we can punt on my second question or answer it later.
No, go ahead and re-ask it.
No, I was thinking about.
You were thinking about.
Wait, Frank, you locked up again. Hold on. You still there?
Yep.
Brad, just ask your question again. Frank, you just ask it and then Frank will answer it, right?
Yeah, there we go.
You
always edit out my stupidity on the front side, right?
No, I remember it.
Let me ask it again. It's okay.
Okay.
So yeah, Frank, I guess, as your son, let's just use your son as the case study here, right? So, he gets back to accumulation. He's bought this house hack and he accumulates for whatever, 20 years. He reaches FI, et cetera. You said at the outset that a lot of your risk parity portfolios are really pertinent when you're at that point of FI or retirement or whatever it may be. But obviously there has to be some transition. I think this is what people struggle with on a granular level, myself included. And people ask me this all the time. I don't have a great answer, right? Which is, hey, I've got this big pot of money sitting in low-cost index funds. I theoretically might want to do something like Frank is advocating, but I don't know how to get from here to there.
Yeah.
And there's taxes, there's all sorts of considerations. Like, how do you actually do that? I think, before we get into the questions from the audience, like, I feel like this is such a fundamental piece that is just so lacking in our community. So I'd love for you to answer it.
Yeah, I think first you do need to design and think about where am I going? What is this portfolio that I want to get into? What does that look like? Because that's the first stage. You don't want to start going down a path and not know where the end is or where the goal is. After you determine that, then you look at what you already have, and a lot of it is going to be the same. So then you are looking at, well, what needs to be transitioned, and how long of a glide path do we really need or want, and how long that is. There's no one size fits all here, but I can give you a basic thumb would be this: that when you are about 5 years out from when you think you're going to, that is the time to think about moving it. And if your portfolio is near an all-time high, then you could move it all at once then and kind of be done with it. I've only recently retired, but we moved our portfolios into retirement style portfolios several years ago. Simply because what you're trying to think about, what you're trying to avoid, invert the question, like Charlie Munger says. What you don't want to happen is you're riding that 100% or high equity portfolio, and you have a stock market crash 2 years before you're supposed to retire. So as long as you can avoid that, you can do a variety of things. You can transition over as many as 10, 15 years if you really wanted to. You could take a little part of this portfolio and test drive it for a while. Or you could just, the sort of the simplest way to do this is, well, I'm getting close and I have enough. Let me do my transition. And in fact, the other rule of thumb would be sort of as soon as you get to your phi number, anytime then is fine, because then you're basically saying, okay, I'm going to convert this to a portfolio which allows me to just stop making any other income any day now, walk away from whatever, ready to ride this. Because one thing you should understand is that these portfolios do not stop gaining money. What they typically do, just for comparison purposes, what's called the real compounded annual growth rate of the stock market since 1970 is 8%, and that is after inflation. If you transition into one of these portfolios I'm talking about, you're basically going to be giving up 1 to 2% of the return. So it's going to be probably between 6 and 8% return after inflation. But what you're getting in exchange for that is essentially half the volatility. So when the stock market goes down 40%, your portfolio is only going to go down 20%. And that is the trade-off, the risk reward. So as long as you are fine with not beating the stock market anymore, and you've got enough for you, you can transition to your retirement or risk parity style portfolio whenever you're there.
You made a great point there that I think people really should appreciate about being in the financial independence community. When you're in the financial independence community, when you have mapped out your path to FI and have a good understanding of what your number is, you know when you have enough for you. Like, that is something that outside of this community, people just generally don't have a handle on. In fact, it's out of scarcity. I need just kind of like a Susie Orman number that we just throw on, make a number up, throw it at the board. It's not based on any sort of logic or reason, mostly on fear. But with what you're describing, Frank, like we've mapped out our number. We're pretty confident in what we're going to need. And then if we hit that number, before our planned exit date or whatever, that might be an appropriate time to start looking at, wouldn't it be cool if I know, like, I could lock in, a portfolio that will give me an estimated safe withdrawal rate. And then, yeah, your portfolio is going to keep going, but you have enough for you. And likely by the time you need it, it'll be and then some.
Yeah, if you're not withdrawing from it, obviously it's just going to sit there and keep growing. So you're just going to have more. The other, I guess, point that I think makes sense to raise here is that when you get there, the end still always on the performance of markets in the future. The most control you actually have is on the expense side of things. And so knowing what your expenses are and being able to modify those or take less in one year and more in another year is honestly, that is the better way to think about managing your retirement rather than trying to optimize something that can't be optimized, which is the performance of your portfolio in the future.
And it's well said, but in episode 172 of our podcast, we did actually have Michael Kitsis on to help us with flexible spending rules for early retirees. So for those of you that are hearing that want to do a deep dive on that topic, or at least begin to approach it, highly recommend you check out that episode. You can just go to choosefi.com/176.
Frank, quick follow-up. So you said something to the effect of, we were talking about like how to actually move this over. You said something to the effect of, okay, if we're at an all-time high, you can just do it.
Yeah, if you want to. Okay. Most people aren't going to be that comfortable, but
right, no, and that's what. So help me out with that. So just this one little piece of it, which is amounts in your retirement buckets. Your 401ks, your IRAs, et cetera, and then in your taxable accounts. So, right, because the taxable accounts, that's what people are worried about. Like, what the heck do I do when I have hundreds of thousands of dollars of potential, cap gains in there? are you moving a lot of this stuff in your retirement buckets, or talk me through like how you would
Yeah,
actually go
okay. You're
about
talking about the tax location issues.
Yeah.
Because you should treat all of your invested assets as kind of one big portfolio.
Agreed.
And so, you don't want to incur unnecessary capital gains in your taxable account, and hopefully you have lots of stocks in there that aren't generating a lot of taxes anyway, and they're paying qualified dividends, which are at the long-term capital gains rate. But yeah, a lot of this can be done in your retirement accounts, and a lot of it is appropriate to be done there, because particularly if you're moving to something like REITs, which are paying a high income but are taxed at ordinary gains, you would want to put that in one of your traditional retirement accounts or somewhere like that. I think the other, and I actually went over this with somebody on my podcast recently, that this does become an issue as to all figure out, well, where is that money coming from that I'm spending first and second? And am I doing some kind of a ladder because I'm an early retiree, or am I in my 50s? I'm going to apply, say, the rule of 55 if you've got that okay and you left then, or are you just going to use that taxable brokerage account and ride that until you get to 59 and a half, which is another option in your 50s. A lot of it depends also on things like, do you have a pension? Is there some other form of income? Are you going part-time? Do you have a spouse that's working? All of those things play into these issues as to how you move these things around. But ideally, you have the least movement possible, and that you locate the things that are paying ordinary income into the other consideration. The other consideration.
Hey, Frank, say that again. You locked up. And paying ordinary income. Just say that sentence again.
That you things that are paying ordinary income, put them in your retirement accounts, because they're going to get taxed at that rate anyway.
Yeah,
when they come out.
That's perfect. So we're going to go ahead and pivot here in just a second to kind of community questions, and we're going to start picking from those of you that leave your comments. So please keep them coming. I've got some of you already ready to go, teed up, and then please just keep submitting them, and we'll kind of dedicate this to your questions. Frank, tonight we're speaking with Frank Vasquez, host of the Risk Parity Radio podcast. And I guess just little definitions of terms here. We've said it, but I don't know if we've defined it. Risk parity. We've also said risk parity portfolio. What does that mean in an elevator pitch or speech for someone that's hearing this for the first time? Risk parity.
This is a style of investing, or a style of a portfolio that has been around since the 1990s. It was pioneered by Ray Dalio, and then all kinds of different people jumped on it and have written all kinds of articles about it in the past 20 years or so. And it's really been something that hedge funds have been doing for a long time, but we now have the opportunity to do that as do-it-yourself investors because we have all these ETFs that are specifically designed for different assets, and we have no fee trading, and we have more options than you did 20 years ago. But the main print on a risk parity style portfolio is finding assets that are uncorrelated or negatively correlated, and combining them in such a way to reduce the overall risk of the portfolio.
So you said finding assets. What are the basket or bundle that we're just generally looking at, like as we're picking what to put in our basket? Are there common themes that we see? So stock index funds, maybe stocks, bonds, different types of bonds. Like what's the a la carte menu here?
Yeah, usually you have that your main driver of returns is still going to be stocks, and you may have between 40 and 60% in that. As the most diverse thing from that, you're usually looking at treasury bonds, and often long-term treasury bonds, and you only need maybe 20% in something like that. You don't need 40% in those kind of bonds. They're volatile and they're very diverse, but a little goes a long way. Then you look at some alternatives. Gold is a useful alternative if used in moderation. If you go, and a good way, a good article to look at for that is go to Big Earn's Safe Withdrawal Rate series, number 34, where he did an 80-year analysis of putting gold in the portfolio. He was trying to prove that it wouldn't help, and he actually proved that it helps. So you can use an ETF for that. I don't buy physical gold. I don't hide it in my backyard. But somewhere between 5 and 15% of in that is kind of useful. Another sidelight. The last time I heard Bill Bengen, the author of the 4% Rule, interviewed, his portfolio is something like 25% stocks, 5% gold, and the rest in fixed income. Right? He's an older guy with a very conservative portfolio, but it's interesting how people have used these things. Then you can look at some other alternatives to put in these portfolios. One of the problems we have with bonds these days is that they're not good income generators anymore. They're just not. That they really only perform useful. The uses they really perform are stability if they're short-term bonds, or diversity if they're long-term treasury bonds or intermediate-term treasury bonds. So everybody's looking for income sources. The kind of go-to two places to go for that are REITs, which have a decent performance. And it's interesting for those. You can use the REIT funds, but they're kind of odd looking these days if you look inside of them, because they're not real estate. They're things like data centers and cell towers and not traditional real estate. You can also just buy big REITs that are just nice real estate REITs, like one like Realty Inc. It's ticker symbol O. It owns 6,000 leases on things like Walgreens, so it's very reliable. The other thing besides REITs to often look at for income is preferred shares, and you can buy a fund. And the common one I use is called PFF. And this, again, if you ask Rick Ferry, what do you invest in? What do you do for income? He does two things. He does PFF and he does municipal bonds, because he's in a high tax bracket. I wouldn't recommend municipal bonds unless you're in a high tax bracket with a taxable account. But those are some ideas. And then you can look at putting other things in your portfolio. If you want to put that Bitcoin in there, you can look at putting it in there. But make sure that it has what's called a volatility match to it. If you have something that's that volatile, and what I mean by that volatile, it's 10 times more volatile than the stock market. You just can't put too much in there. It's like 1% or 2%. Otherwise, it just dominates the performance of the portfolio. But it is possible to construct different portfolios where you have the key factors being the stock funds and the treasury bond funds, and then looking at sort of a basket of alternatives. 6 sample portfolios on my website that I update. They're live. And we update them every week, and they're on Fidelity, and you can monitor them and see what's in them to get some ideas if you're interested in pursuing these sorts of things. Now, one thing I didn't talk about was the different kinds of stocks that you can put in, because
that's great, because I was actually going to tee you up for this question from Andy, and he says, thanks for the live event. Frank, what percentage of stock portfolio would you recommend investing in international stocks? And I just want to kind of reframe that just a little bit in terms of, like, if we're looking at this through the lens of diversification, it's probably important to figure out what is the goal here, right? So in terms of, like, if we're saying, all right, we have this stock, let's say we have a total stock market index fund, but, should we get a world fund, or should we tilt towards international? It's a slightly different conversation than what we're discussing, which is a different form of diversification. Really, we're looking at correlation.
Yeah, and that is actually the way I look at these things, at all of these things. So let's take international funds. The issues we have with international funds these days is a lot of them are highly correlated with U.S. funds. So you're not getting your grandfather's diversification anymore. Back in the 80s and 90s, if you bought like a fund of European stocks, it was only like 20 or 30% correlated with U.S. stocks. Now it's often these funds are over 90% correlated. And so that if you have something that's that correlated with what you already have, it's not very useful to you. That you ought to just pick one or the other.
What accounts for that? Is it just the growing size of corporations? Like it's just kind of a consolidation of.
Yeah, I'm not sure. I ask myself this question all the time because I think one of the problems with a lot of international stock funds is that the stock markets in a lot of other countries don't actually reflect the economy of the country. What often reflect specialized stocks that people like to put in those countries. So if you buy Canadian stocks, you get all these mining stocks and oil stocks. You don't get the Canadian economy. That's a guess. The other kind of stock you often see, particularly on the European side, are essentially large banks, large cap value kind of stocks that are similar to large cap value stocks in the United States as well. So this is something I've actually been trying to wrestle with and trying to look for funds that actually reflect what is going on in other economies. And I don't have a clear or good answer to this. One of the newer things that is possible to invest in now is called China A shares. And those are Chinese companies that are listed on Chinese exchanges and pretty much only there. Those tend to be much less correlated with U.S. stocks and most other international stock funds. So, I mean, the short answer to that question, I would say, is somewhere between 0 and 20%. I don't think you need them, at least at this stage. If you're looking at the sort of typical big international funds, they're not doing what they're kind of advertised to do these days. If you want to know whether something's correlated, again, I would go to the asset correlation tab or link at Portfolio Visualizer, and you can take whatever fund you are thinking of investing in and line it up with your U.S. stock funds, and then look at those correlations. And that's often what I do. Is if somebody suggests something, one of the first things I do is I go put it in there and say, well, is this different from the things I'm already investing in? Because if it's not really different, then it either has to take the place of something. You exchange it. I'm not going to invest in that anymore. I got this one, or it's just not that useful. And so that I think of these in terms of a process of deciding whether something is useful in my portfolio or not. Do I already have something in there that does that as sort of the process? And so looking at that correlation and then looking at the correlation with what I have, the performance overall of what this thing is, and then what is its volatility? Is it nice and low and doesn't move around much, or is it have a high volatility? And that tells you oftentimes how much of that if it's like Tabasco, you don't want to fill your portfolio with it, or you'll burn
overwhelming.
So, Frank, I think that ties into Luke's question here, which is, have your views changed on factor investing? And do you have or plan to add or plan to add small cap value to your portfolio. So I guess that's something Paul Merriman has talked about. And I guess, this ties in also, like there's this narrative that we're weaving, right? Of, like, as you said, it's performance, it's the correlation. And, how does all this, is it worth it to put this in? Right. Like, so I'd love to hear your thoughts on Luke's question.
Yeah, this is a great example. And I do have small cap value funds in my portfolio because oddly enough, they are less correlated with the overall stock market than an international fund.
Really?
And so what you can look at, there are a couple of different ones. The one that seems to be the least correlated is based on the S&P 600 small cap value index. And so an ETF like VIOV, which is a Vanguard ETF, and there are several other ones that follow that same index. But if you took that and you put it in that correlation analysis, it comes out at 0.77. And that's a low correlation for two stock funds. If you put in one of those international funds, it's gonna be over 0.8 and up to, and maybe even over 0.9, which means they're just totally correlated. So having a good, if you wanted a basic two fund portfolio in that was your stock portion. If you put a large cap growth fund and a small cap value fund, those are good as just a very basic, okay, I want to cover the whole market and I want some diversification here. Where you see this performance is interesting in that the large cap, and people are seeing this now because there's more reflation or inflation in the economy recently. And so small cap value stocks have been dogs for 10 years. And then
it's a very long time to be a dog when you're a believer.
And then all of a sudden in the past 6 months, they're up like 70%. Yeah. So they've gone a little crazy, and historically also you'll see that, for instance, people look back to the 1970s as a really bad time for stocks, and the stocks did not perform well for most of that decade. But small cap value stocks actually, after the recession in 1973-74, for the next 12 years, they went up every single year. And you couldn't say that of most of the stock market. So it is a diverse sector of the market. The other thing that plays into this is the fact that a total market fund like VTSAX or VTI is heavily weighted towards large cap growth just by its nature, because it is cap weighted. It has more of the largest stocks in it. And so when the largest stocks are growing the most, it ends up having lots and lots of those. So a total stock market fund is actually mostly large cap growth and some large cap value.
So is the correlation between a total stock market index and an S&P 500, is that like 0.98, 0.99?
0.99.
It is.
Yeah, just pick one.
Yeah.
You don't need both, and that is an example of a kind of a false diversification. These things have different names, so they must be different, and no, they're really not. There's also a great amount of overlap. And that's one of the things I think amateur investors get caught up in. They pick stocks or funds like they're going to the supermarket and said, "Oh, I'll just get a little bit of this and a little bit of this and a little bit of this," but they didn't have a recipe, and so they end up with a whole bunch of things that are, they're all different cuts of meat, and you don't have any vegetables, and so the other thing that you really want to be cognizant of is not only did you analyze the correlation between these two things, but do they actually have the same things in them? Because a lot of these funds have overlapping.
Let me get your take on that. Just to kind of not pin you down per se, but just to since we've addressed both of them, we've talked about all the ingredients. Let's come back to free your finances question. What are your thoughts of the fact that index funds are cap weighted? We just talked about that. So as a company becomes more overvalued, its market cap may well increase too, leading it to be overweighted in the index. So all of this is literally what we just said. You know, overvalued maybe or maybe not, but certainly things are tilted towards, you know, these very large growth companies. And it sounds like we were just discussing that, you know, small cap value has a little bit less correlation. And so now with, you know, those ingredients in mind, just kind of set you up for this kind of this comparison here. We have just a very simple approach, which is buy a total stock market index fund. Yes, it's cap weighted, but to JL Collins' point, it's also self-selecting, which works for you. So it, you know, if a company becomes less valuable, then you're also progressively owning less of it. It's a self-cleansing mechanism. And then on the other side of that, we have, instead of being cap weighted, let's have equal amounts of various asset classes. It's kind of the Paul Merriman approach. And let's have some small cap, it's a small cap value. Let's have some large cap. Let's kind of like try to hit these different asset classes in the stocks, I guess, in this case. Let's try to hit them a little bit more evenly. Where do you land on that? Where's in your mind, for you personally, or just kind of as you're looking at it through risk parity, where is that line of delineation between complexity and
the simplicity principle?
Yeah, the simplicity principle.
That comes from Rick Ferry, and basically he's his criticism and Jack Bogle's criticism of Paul Merriman's 10 funds portfolio is that it's just too complicated for most people to manage, which is why Paul Merriman has gone and given easier alternatives to his portfolios. But getting to your question, think about these funds. They are self-cleansing in different ways. So and that's what's interesting about index funds, is that they're not static. A fund like VTSAX, which is cap weighted, is getting more and more of the larger companies all the time. So as companies do better, the fund acquires more of it. It's basically a momentum following fund. And then as companies in there are doing worse, they fall down in the rankings or fall out of the rankings if it's an S&P 500 fund. Think about a small cap value fund is doing the reverse. When it gets too big, it gets kicked out. when it gets too growthy, it'll get kicked out of the fund, because that's also based on an index that is changing over time. So each fund has a little bit different rules to it, but I think the idea that I come back to is let's get the ones that are basically on the different ends of the spectrum, which are that large cap value one and the large cap growth fund and the small cap value fund. Then if you want to add some other things in the middle, you can try them out and see what they look like if you analyze their correlations. I think the problem is after a while, it just ends up, like I said, they end up being too similar in performance overall, and they just add complexity without adding anything in particular in terms of not making your portfolio any less volatile and not making your portfolio perform any better. So after just a few of these funds, you find that you end up with just more of a random performance. There's an important principle that I think most people have a very difficult time comprehending, and it's called the macro allocation principle. And to learn about this, you need to go to the book of Jack. The book of Jack is Common Sense Investing by Jack Bogle.
Yep.
And chapter and verse from chapters 18 and 19 where he discusses this. And what he says in there and what has been proven over time is that what matters the most in constructing a portfolio is those macro allocations. Is it 50-50 stock bonds, 60-40, 80-20? And then you can expand that out to if you have other alternatives, is it 50-30-20? Is it for depending on how many different total asset classes you have. But what he's saying is that any 60-40 portfolio is likely to perform over 94% the same as any other 60-40 portfolio, which is it's difficult to understand, because what it's telling you is that by spending all your time fiddling with the stock funds is not really going to change your likely performance that much. It's getting those macro allocations down between the very different asset classes that is really going to drive what your portfolio is. So think about a 100% equity portfolio. Basically, what this is saying is, if you grab a bunch of reasonably diversified stock funds and compare that to just VTSAX, the odds of them having the similar performances over the next 10 years it's higher than 90%.
Wow.
And the difference here, and this is what people don't like to hear, is most likely to be random. And that what it means is we are kind of stuck with having. If you try to over optimize based on the past, in particular, in the recent past, you're likely to have something that actually doesn't perform as well as something that is just kind of basic and covers the bases as far as that portion of your stock portfolio that's in stocks. And caveat this is, I'm not talking about stock picking. If you're a great stock picker, yes, you will outperform the market, but I'm really focused on.
If you're a bad stock picker, you will underperform the market.
I'm talking about somebody who's putting together portfolios of diversified funds, and that's what Jack Bogle was talking about.
Brad, I just want to let you know, I'm going to go ahead and go grab Claudia's question. I wasn't actually 100% sure. Are you able to pick comments from the sidebar? So if you are, we'll just alternate and highlighting them. But I'm going to go ahead and bring Claudia's up here.
I don't believe I'm able to.
Here, let me, Claudia, I'm going to bring you right back real quick. Brad, try and click on one, see if you can pop one on the screen. And then if not, then,
no, it doesn't seem like it.
Okay. So I will tee this up, and then
you're doing a great job picking, so it's all yours.
All right, sounds good. All right, this is Claudia's question, and Frank, going back to bonds here, she had a question about a bond tent. So I would probably need a definition of terms here, and it seems like she's questioning what it would do for a sequence of return risk. Why would you be interested in one?
Okay, yeah, a bond tent is an old-fashioned way of dealing with sequence of return risk before you had a lot of different bond funds. And what you would traditionally do to create a bond tent, and this is going back to the 1980s, is you would actually go out and buy bond issuances. Frequently, you would do this with treasury bonds, which you can buy straight from the government. And so you would line up a portion of 1-year bonds, 2-year bonds, 3-year bonds, 4, 5, 6. And that's typically what you would do, the short terms for a bond tent for that. And you can do that, and it will help you, but it's not going to be functionally different than buying, say, a short-term bond fund and an intermediate bond fund that are already tinted for you. Because if you look inside the specialized bond funds, and they are now, you can get short, intermediate, and long-term in treasuries, in corporates, there are probably, I did a couple of bond episodes for my podcast and basically broke them out into, I think, 20 different kinds of bond funds that are available now. And so it's the same idea that the shorter term bonds are going to be the most stable. And then the idea of a bond trend is when the 1 year rolled off, you would put it back up on top at the 8 to 10 year. It still would work fine. I just don't think you necessarily need to do that anymore, that you can construct the same kind of thing using the appropriate bond funds.
So that sounds similar to what you said about Ray Dalio and his portfolio in the 90s, right? Like, we as normal people might not have had access to this, so we would have had to have resorted, I guess in this case, to this bond tent. But you're saying there are funds that do that for you. So it sounds a lot.
That stuff didn't exist back then. It existed in terms of bond funds were mostly managed mutual funds, which were, and they still exist, but they're expensive. You didn't have the ETF universe that you have now, which has really only existed for about the past 20 years, I would say. Really, they started coming more online in 2003 and 2004, and then you had more options then. But if you go back into what I call the Bronze Age of financial advice back in the 80s and 90s, financial advisors were constructing portfolios out of individual stocks, individual bonds, and a few funds that were expensive. And it's amazing how grossly expensive things were in the past. You used to have to pay an 8% load on a mutual fund back in the 1960s.
You hear that, people? You're living in the golden era of investing. Do you appreciate how easy you have it?
We are really living it. I call this going into the age of steel. That the Bronze Age was from the 70s and the 80s when were putting together the first 60-40 portfolios, but they were doing it out of whole cloth. And then you get to the Iron Age, which is basically the age of index funds coming online and Jack Bogle getting things together. And now I feel like we are going to the age of steel, where we have no fee trading and fractional shares and ETFs and virtually anything you want to buy. So if you really want to buy coffee or cotton, you can buy an ETF that does that. Which is unbelievable to me at this point, but
it's all out there.
It's all there for you. That may be why it's kind of getting kind of overwhelming. But
hopefully we can just focus a little bit more on what the 80-20 is inside of that. Those really huge selections. Frank, I wanted to go back to this point that you made earlier, and it was just kind of that bonds have kind of been unattractive of late. And I think it kind of goes a little bit here to what Igor's saying. He says bonds should be opposite of the market, but lately bonds have moved with the market. So what space does that leave for us to use bonds? And I wanted to kind of tie a couple other things for you to touch on here. I know there's been some movement in the long-term treasury yields, interest, the 10-year interest rate. There's just a few things going on in the background. I'd love for you to kind of talk through what is working well in the bond community, where do they work well, and maybe kind of why some people have soured on it to some degree of late.
Yeah, I think well, the first problem is different bonds behave differently. And again, this goes back to correlations that one of the problems we have with total bond funds is, first of all, they don't cover the total bond universe. They cover whatever the purveyor of that thought should go in a total bond fund. The second problem you have is bonds are positively correlated with stocks, and they always have been. In particular, if you go out to junk bonds or what's called high yield, those are 70% correlated with the stock market. So you're not getting any diversification out of something like that at all. And you're not getting much diversification out of other corporate bonds, even the high quality ones. So what that leaves you with is really focusing on treasury bonds for diversification. And this is why, for instance, if you ask Paul Merriman what's in his portfolio, all of his bonds are treasury bonds. They're all treasury bonds because they are the most diversified from the stock part of it. And so when you are thinking, I don't use corporate bonds at all. I might use them if they paid a higher yield than they do, but I can't see the risk reward right now. But if you look at the treasury bonds, just the treasury, they have been uncorrelated with the stock market. Go back, and you can go back to last year. This really comes out front and center when you have a stock market crash. So when the stock market went down last March of 2020, 40%, the long-term treasury bonds were up 25 to 30%. And so you could see that is why most risk parity style portfolios in that time period were down a maximum of 20% if they were well constructed. And then you get a rebalancing opportunity because you sell the bonds when they're high and then buy the stocks when they're low, and everything's glorious. It's true, though, that in the past 3 months, we've seen in bonds a very bad performance, particularly in long-term treasury bonds. That it's been the worst performance in 3 months since 1980 for those funds. And this is why you want to be well diversified, because what was doing well and what typically does well when those bonds are doing poorly are small cap value funds. And so the small cap value is up, 30, 40%. At the same time, the long-term treasuries are down 14%. And that's what happens in these kinds of portfolios. I think that what is jarring about that is people really want to have all of their stuff going up at once. But if you really want to get a diversified portfolio, and the hallmark of a very diversified portfolio is you will see things moving in different directions at different times. And it does take a little bit of just getting used to that. I think that it's hard for whatever reason for people to wrap their heads around that, but that's fine. We're all learning and figuring this out.
And Frank, that's what I wanted to follow up with. So, a lot of people, many people in our community are heavily concentrated in low cost index funds. And then maybe like somebody like me, like, oh, I'll diversify, right? I'll get some real estate. And so I have some single family rentals, patting myself in the back. I'm diversified, but I have no idea how correlated they are, right? And like, that's my question to you is like, I think a lot of people think, okay, I'm doing well. I've got these two different asset classes, but some black swan event hits to the economy. Are they uncorrelated? No. I mean, if people are losing their jobs, are they, so
there's that existential problem,
right? I'm not patting myself in the back anymore. Then, so talk me through real estate.
All the
and
pats
stocks.
are gone.
They're completely gone.
I think in most times that real estate and rentals, I'm talking about not REITs, but rentals and stocks have a low correlation.
They do have a low correlation.
Yeah, they just do, because you're running a little business.
So I can pat myself on the back.
Yes, you should. Yes, you should. That's a very good way of diversifying. Is to own some rental real estate. But it's a little business, and you need to
have completely separate argument. Yeah,
manage it, and it's subject to its own idiosyncratic where it is, what the rentals are like in that area, and that's a whole separate topic that I'm not an expert in. I have one rental, but yeah, that's a very useful thing to have as an uncorrelated asset. But you are right in that that existential crisis, 2008, it is possible for these things to go down together. I think on the real estate side, the real question is not taking too much leverage. That's borrowing too much money. That's how people got into trouble back in 2007 and 8, is they had, borrowed lots and lots and had a bunch of rentals that they couldn't support the mortgages for if they didn't have a renter in them. That's you don't want to be in that kind of position. But that has more to do with taking too much leverage than a correlation issue. Gotcha. I think that a separate business is a nice thing to have, and that's actually why I like a lot of the individual REITs, is because I look at them like businesses, and the specialty ones are very interesting. I mean, you can buy a Weyerhaeuser, WY, which what it does is it grows wood. Wow. It grows managed timber and sells it to Home Depot.
Is doing very well right now,
and it's a business, and it went up 116% since last March. For it's just a simple business. There's another one, ticker symbol. It's Lamar Advertising, LAMR, and it is in the billboard business.
80 miles of south of the border, I'm pretty sure.
So it rents billboards.
I've driven up and down I-95 recently.
What is going on there?
And so I like those things because they are like separate businesses with their own thing going on. To me, those are more like having a real estate business or any kind of thing on the side that is essentially have a low correlation with the stock market.
Let me kind of create this framework for people and for myself, just to kind of see where you land on this. But I want to really think about these terms, diversification versus correlation, and see, are they the same? Is one being misused? Can you be very well diversified but have really bad correlation? Like you want, you do not want it to be correlated, but oh, my friend, you are.
To me, I think that diversification should mean uncorrelated. In my perfect world, where people use terms the way I'd like to use them, I would say that diversification should mean uncorrelated.
And so I guess for people listening, I agree with you. I tend to agree with you, and I realize that is not the way that most people think about diversification. They just think about lots of random different things, and until maybe an episode like this, they don't really have a quantitative measurement. It's all qualitative. Diversification as a term feels very qualitative. I think that I'm all over the place. I've got lots of different stuff.
I've got lots of stuff. I'm diversified, and you don't know until you actually go run a few numbers, and then you can see. I mean, the sort of the emergent property of a diversified portfolio is low volatility or lower volatility than you would expect. And then it plays into these risk reward measures. And I don't know how far you want to go into that. There's something called the Sharpe ratio. There's something called the Sortino ratio. And those are ratios that measure the risk versus reward of a portfolio. And the higher you have there, the better risk reward ratio you have. But what plays into that are diversification and how stable or unstable the components are.
Well, Frank, we barely scratched the surface of the questions that are continuing to come in. Would you be interested in joining us for like a monthly chat, and we'll just come on Facebook and take people's questions and continue to do this? It's just, it's
I'm
a lot
retired.
Of fun. You are. Congratulations. We should talk through that. What you're doing on the side.
And I do answer some particular to my podcast for people that send them into that. But that's
well, let's start there. So go ahead and tell people about your podcast and where they can find it. I'm sure there's a lot of people that are going to want to pick up this conversation over there.
Yeah, it's called Risk Parity Radio. And you can find it if you search Risk Parity or Frank Vasquez in any podcast place. I think I'm the only one that has a name with risk parity in it. And there's the podcast, and what we talk about in there is these kind of time. It's a very focused podcast. I try to just keep it on that because there's so many other better, broader podcasts about other things, but I do answer sort of all kinds of personal finance questions that just come up. So the other thing that's interesting about it is that I have taken and created 6 sample portfolios over at Fidelity and update them every week. And so there's a very conservative one called the All Seasons. Then there are sort of 3 middling ones. One is called the Golden Butterfly. One is called the Golden Ratio. One I call the Risk Parity Ultimate. And then I have 2 experimental portfolios that used leveraged funds, which is a kind of a new thing going on out there. I just wanted to see what would happen. So we talk about those every week and how they're doing and what's going on with the various components of those. And talk about different kinds of investments. And what I like to use, and this, for anybody who's really interested in investing, I think one of the best books that's come out in most recent years is by J. David Stein, who has a podcast called Money for the Rest. Wrote a book, Money for the Rest of Us, 10 Questions to Master Successful Investing. And he is a former institutional fund manager who knows 4 or 5 times as much about stuff as I do, and how to invest in all kinds of things. But he's got these 10 questions, and I use those as a process for talking through various kinds of investments and whether we might use them or how we might use them in a retirement portfolio. And people have suggested various ones. And we've talked about those, and there's one about REITs, and there's one about utilities, and we talk about gold, and we talk about Bitcoin. And if you go through I have over 70 podcasts now. I just started doing this last
70
July.
podcasts.
Go, Frank.
Yeah, I just started. They're short.
He's retired, people. He's
I just started doing it last July. I try to do 2 a week.
Nice.
But
they're
also
pretty short, right, Frank? They're sub 30 minutes usually.
Generally, yeah, most of them. I've got a couple of longer ones, but I think the longest one is 50 minutes.
Well, you got Jason who just commented saying, I just subscribed to Frank's podcast. And we've got Jennifer saying, once a month investing chat, count me in. Julie, monthly Q&A with Frank. Yes, please. So yeah, I think we've got some fans here. So yeah, Frank, this was an absolute blast. Thanks for taking out the time.
Yeah, sure.
Taking time out.
This is fun. I'm glad there are people that like to nerd out on this stuff,
Yeah.
and I do want to say that you don't have to nerd out on this to be a successful investor. You can set it and forget it if you prefer to do it that way, and you'll be just fine.
All right, one last time. That's Risk Parity Radio. I can tell you that as soon as Brad and I heard that Frank had started a podcast, we're like, that is going to be popular in this space. And very specifically in this space, that is going to be a well-received podcast. And Frank is a huge wealth of knowledge for his community, and very excited. We'd love to make this type of show happen a little bit more often for you. I think it's fun, it's informal, and we love getting your questions live like this. It allows us to react to, real-time scenarios that are potentially pain points in people's lives. And it's good to have these conversations. All right. Well, with that, the fire is spreading, my friends. We'll see you next time as we continue to go down the road less traveled.
Thank you.